Right now, we are witnessing so much turmoil in so many different sectors of our economy. The housing market is crashing. The cryptocurrency industry has imploded.
US, where economy is heading into a recession, which is short and shallow, it can come over the coming year. This according to a poll by Reuters. Well, the economists also expect US Federal Reserve, the Reserve Bank or central bank to go for a smaller 0.5% interest rate hike on 14th of this month. The Fed has another half point at least to go with rates early in the new year, with inflation still running well above Fed's 2% target, even though economists put a steady 60% probability on a recession taking place in 2023.
The tech industry is laying off workers at an extremely frightening pace, and some of our most important retailers are heading into bankruptcy. In this video, we will show you the factors that are causing the bankruptcy of many businesses and shops worldwide. But before moving on, don't forget to subscribe to Financial Countdown and ring the bell to be notified when new content comes out. The information that I am about to share with you is deeply troubling. It has become exceedingly clear that our economy is in huge trouble.
As we reported, the U.S. economy slowed down over the first 3 months of the year, the first time it has contracted since the pandemic brought it to a screeching halt. There have been other troubling signs, most notably inflation and concerns over the rise in borrowing costs.
And I fully expect that our problems will accelerate even more as the year rolls along. Amazon has sacked more than 18,000 workers. Microsoft this week announced thousands of job cuts, becoming the latest tech company to cut its workforce in the face of the global economic slowdown. Microsoft reported that the layoffs would affect approximately 5% of its workforce.
Now, US production and retail sales have plunged, and this is added to fears that the world's largest economy may already be in a recession. And these risks have knocked the global financial markets. Wall Street stocks took a bit of a beating after weak economic data and also the Federal Reserve's rhetoric of more rate hikes to come. The fresh wave of gloom is compounded by news of massive layoffs by big global firms pretty much on a day-to-day basis. Now, the data on Wednesday showed a decline in terms of business investment and also a slowdown in the US consumer spending. The American retail sales fell by more than they had in a year, while producer prices plummeted by the most since the pandemic began. But that did not stop the Fed policymakers from reiterating the need for more rate hikes to fight elevated inflation.
With some notifications taking place as early as this week, even more alarming is the fact that Tesco's declaration to go into administration has become likely in the coming months. Added to this, more than 2,000 jobs are at risk at Tesco, which is announcing further changes to the management of its supermarkets within days. Last week, Asda, Britain's third largest supermarket, said it planned to lay off 200 night shift managers and change the hours of 4,000 workers.
Well, what we really saw was sort of a tale of two economies. We saw the domestic economy, the consumer, home buying, building, and business investment all accelerated in the first quarter, off the fourth quarter, while the trade deficit absolutely ballooned. We saw exports fall at their fastest pace since the onset of the pandemic in 2020, as everything from the Omicron wave to the war in Ukraine and new lockdowns in China take a bigger toll on growth abroad than at home. We also saw continued double-digit gains in imports here in the United States as we were trying to bring in and catch up on losses from the Delta wave last summer. So, where we saw the strength was really the pillars of the U.S. economy, the consumer, the housing market, although all cash buyers are clearly pushing out first-time buyers, and business investment actually accelerating. That resilience that we saw off of 1.7 million jobs generated, something that was like what we would do in a year in the 2010s in one quarter, that helped to buoy the domestic economy even as the foreign side of the economy imploded, and government spending also fell quite dramatically as defense spending was cut. Now we know that's going to be reversing course soon too.
Other big firms have been in talks with potential buyers and lenders as it works to keep its business afloat during a likely bankruptcy filing. According to people familiar with the matter, the wave of layoffs we are witnessing in the tech sector is unprecedented. So far, more than 25,000 workers in the sector have already been laid off this year, following last year's mass layoffs. At the moment, almost everything is going in the wrong direction for the world economy.
150,000 tech workers have been laid off in 2022 alone.
Amazon today announcing it's going to cut 18,000 workers.
We're going to see more. It's going to continue to weave through the public and private market.
Is the tech bubble bursting again? The layoffs in big tech, which started in 2022, left many wondering if this is just the tip of the iceberg. So what does this mean for these workers as well as those aspiring to join the tech industry, especially when the economic outlook remains uncertain? Technology is a part of our everyday lives and a necessity for most societies to simply function. This increasing dependency has seen huge growth in the tech sector and with it, a proliferation of high-paying jobs. But following the industry's recent struggles, those exorbitant salaries are now being scrutinized like never before.
But most people still do not understand the big picture. The wave of layoffs and bankruptcies around the world is due to a combination of factors, including the COVID-19 pandemic, the Russian invasion of Ukraine, inflation, currency devaluation, over-indebtedness, making debt repayment difficult, economic and financial uncertainty, declining economic activity, increased regulation and supervision, and falling incomes. Long days of strikes by the different trade unions and threats of layoffs are what you hear and see in the news these days.
What has happened in the last 3 or 4 years is that pay for the other non-big tech companies have gone up, and many of the startups are really upset because they can't burn cash at those rates. They can't pay 7-8K for fresh grads. The big tech companies will continue to pay what they used to pay. They always pay a lot. I suspect that the growth in the median pay will either stagnate or may even drop.
Teo Shun Jun falls within the bracket of the median pay earner. The former Tencent data analyst engineer was let go by the Chinese tech giant at its Singapore office in 2022.
Many experts assume that we will only suffer a temporary recession and that things will be back to normal in a couple of years. I wish it were true, but deep down we all know that getting the economy back to 2020 levels will not be easy, unfortunately.
Markets started Thursday on a pretty weak note. The dollar rose across the board, hurting these countries which do not have enough dollars to cover importing essential items such as food and fuel, such as Sri Lanka and Pakistan.
Our whole system is beginning to crack and crumble around us, and those who currently run things will not be able to put it back together. Your opinion is very important to us. You can leave it in the comment box below this video. Thanks for watching.